Let's begin with a question that many people ask themselves, often in quiet moments of frustration or late at night when financial worries keep them awake. Why does it seem like some people, year after year, consistently get richer, while so many others work harder than ever and still feel like they are falling further behind? It's a feeling that can be incredibly disheartening. You see headlines about new market highs and stories of overnight success, yet your own financial situation feels stagnant, or worse, precarious. It feels like there's a secret game being played, and you were never given the rulebook. This feeling isn't just in your head. It's a tangible reality for millions. You follow the traditional advice. You get a good job. You save what you can. You try to avoid unnecessary expenses. Yet, despite your best efforts, the goalposts seem to keep moving. Inflation eats away at your savings. Unexpected bills derail your progress, and the dream of financial security feels perpetually out of reach. You might look at your friends, neighbors, or influencers online and wonder what they know that you don't. Is there some hidden knowledge or a special trick that separates the financially successful from everyone else? This divide isn't a matter of luck. It's not about being born into wealth, although that certainly helps. It's also not necessarily about raw talent or genius-level intellect. The difference, more often than not, boils down to one single powerful word: strategy. The people who consistently build wealth operate with a clear and deliberate plan. They understand the fundamental principles of how money works, how markets behave, and most importantly, how to manage their own emotions. They aren't gambling. They are executing a well-thought-out strategy designed for long-term success. They see the financial world not as a casino, but as a system that can be navigated with the right knowledge. So, the core question isn't just about why some get richer, it's about what specific strategies they are using to achieve that outcome. How do they make decisions? Where do they put their money? What do they do when markets are volatile and everyone else is panicking? Answering these questions is the first step toward closing the gap between where you are and where you want to be. It's about shifting your perspective from being a passive observer of the economy to an active participant in your own financial destiny. This is the journey we are about to embark on together, so let's get started. Many people attribute financial success to external factors that are seemingly beyond their control. They might say someone was just lucky to have invested in the right stock at the right time, or that they had an unfair advantage because of their connections. While luck can certainly play a role in short-term windfalls, it is an incredibly unreliable foundation for building lasting wealth. Relying on luck is like trying to navigate across an ocean without a compass, hoping the currents will magically carry you to your destination. It's a passive approach that leaves your financial future to chance, a gamble that rarely pays off in the long run. The truth: sustainable wealth comes from a deliberate, repeatable strategy. It's not about a single lucky break. It's about a series of smart, informed decisions made consistently over time. Smart investors don't throw darts at a board. They analyze, they plan, they execute with discipline. Think of it like building a house. A house built without a blueprint, with random materials and guesswork, will likely be unstable and collapse at the first storm. On the other hand, a house built from a detailed architectural plan with a solid foundation and quality materials can withstand storms and stand for generations. Your financial life is no different. A strategy is your blueprint. It defines your goals. It outlines the steps to reach them. It provides clear rules for making decisions, especially under pressure. Understanding strategy is empowering. It demystifies wealth creation and puts the power in your hands. Financial success isn't a secret for an elite few. It's a skill anyone can learn and apply with effort. The smart money isn't a mysterious insider group. It's any investor who prioritizes strategy over speculation, planning over panic, and long-term discipline over short-term gratification. This is the fundamental mindset shift we'll be exploring, you know? In this breakdown, I am going to pull back the curtain and show you exactly how smart money is positioning itself for 2025. My promise to you is simple. We will skip the hype and focus exclusively on the results. This isn't about chasing the next hot trend or promising you a shortcut to getting rich overnight. Real wealth isn't built that way. Instead, we focus on timeless principles and practical strategies proven across market cycles. No confusing financial jargon, no overly complicated charts. Finance is often made to seem more complex than it needs to be, which can intimidate beginners and even experienced investors. My goal is to break these concepts into simple, understandable language. We will talk about stocks, crypto, passive income in a way that makes sense so you can feel confident. You don't need a degree in economics to build wealth. You need clear, honest information and a solid plan. This is not a platform for fake gurus or financial entertainers selling dreams on flimsy evidence. The internet is full of promises of guaranteed returns and secret formulas, often preying on the desire for a quick fix. We take the opposite approach. Our focus: calm, authoritative facts and strategies that prioritize safety and sustainability. This is education, not entertainment. The aim is to empower you to make your own informed decisions, not to follow speculative bets blindly. By the end of this guide, you'll have a clear, comprehensive approach to modern investing. You'll know where smart money is flowing and why it flows there. You'll learn the critical mistakes that make most investors lose money and how to avoid them. Most of all, you'll walk away with a practical framework for building long-term wealth, aligned with your goals and risk tolerance, so you can build your financial future on confidence and clarity. So, what exactly will we be covering? We are going to dissect the core components of a modern, intelligent investment portfolio, step by step. First, we will dive deep into the world of stocks, not day trading or trying to time the market. The smart money approach, identifying high-quality companies, dollar cost averaging to build positions over time, collecting and reinvesting dividends. As US News notes, while the AI fever of previous years may be cooling, the broader market continues to advance, presenting new opportunities for disciplined investors. Next, the controversial world of cryptocurrency. Many people see crypto as a digital casino. Smart money sees it differently. They treat crypto as a high-growth, high-risk slice of a diversified portfolio. Proper allocation. Experts often suggest conservative limits. Suggested range: 1% to 5% for most investors. We'll look at how institutions are approaching this asset class. You can apply institutional risk management to your strategy. Focus on long-term projects, not meme coins. Beyond stocks and crypto, passive income. Smart money loves cash flow because it creates financial stability and freedom. As interest rates on simple savings accounts decline, income strategies matter more than ever. Avenues include high-dividend stocks and ETFs, and even digital assets that can generate revenue while you sleep. The goal is to build systems where your money is actively working for you. Finally, risk management and mindset. This includes common beginner mistakes and how to avoid them. The dangers of overconcentration, the pitfalls of following social media hype, emotional discipline, buy when others are fearful and sell when they are greedy. Wealth is built by avoiding catastrophic errors as much as making smart investments. This holistic playbook will guide you through 2025 and beyond. Section 5. The real goal. Building sustainable wealth safely. As we go through each of these topics, it's important to keep the ultimate goal in mind. The objective here is not just to make money, it's to build sustainable, long-term wealth in a way that is safe and manageable. Chasing quick profits often involves taking on excessive risk, which can lead to devastating losses. The smart money approach, in contrast, is about playing the long game. It prioritizes the preservation of capital just as much as its growth. It's a marathon, not a sprint, and the aim is to ensure you are still in the race decades from now. By the end of our journey, you will have a clear picture of where money is flowing in 2025, from broad market trends to specific sectors like healthcare, energy, and AI. This knowledge will allow you to position your portfolio intelligently, allocating capital to areas with strong fundamental tailwinds rather than just chasing past performance. Knowing the why behind market movements is far more valuable than just knowing the what, as it enables you to adapt your strategy as conditions change over time. More importantly, you will be equipped to recognize and steer clear of the most common and costly mistakes. We will highlight the behavioral traps and emotional biases that cause so many investors to fail. By learning to identify these pitfalls, you can protect your portfolio from your own worst instincts and stick to your plan even when it feels uncomfortable. This emotional resilience is one of the most significant assets an investor can possess. Ultimately, this is all about building a secure and prosperous future for yourself and your family. It's about creating a level of financial independence that gives you options and freedom. The strategies we will discuss are not theoretical. They are the practical building blocks for achieving that reality. By watching this all the way through, you are taking a significant step toward acquiring the financial education needed to navigate the world with confidence. You will learn how to make your money work for you, how to compound your wealth safely, and how to build a legacy that lasts. Table of Contents, Part 2, Act 1. What smart money really means. About 8 section. Section 1. Deconstructing the smart money myth. When people hear the term smart money, their minds conjure an intimidating image. Towering glass skyscrapers in New York or London, rooms filled with frantic traders at a wall of monitors, or shadowy billionaires making billion-dollar bets in secret. The phrase is commonly associated with hedge funds, powerful institutional investors, and Wall Street insiders, who seem to possess near-magical clairvoyance to predict markets. This perception creates a sense of exclusivity, like a private club with a guest list you'll never be on. It implies financial success is reserved for a privileged few. But that portrayal is a fundamental misunderstanding. While large institutions do have access to resources and information, being a smart investor isn't about the size of your bank account or the prestige of your employer. It's not about a secret algorithm or insider tips. The core of smart money thinking is accessible to everyone because it's about how you think and the principles guiding your decisions. It's a mindset, not a membership. The myth of exclusive smart money is disempowering. It convinces people they're perpetually at a disadvantage, the dumb money institutions exploit. That can create helplessness and stop people from participating in markets, which means missing out on one of history's most powerful wealth-building engines. In reality, top long-term investor principles are remarkably simple and adoptable by anyone, regardless of background or starting capital. Our first step: deconstruct the myth and redefine smart investing. Peel back the mystique to reveal simple, powerful truths at the center. Smart money is a way of operating. Disciplined capital that prioritizes logic over emotion, strategy over speculation, and patience over instant gratification. Internalize this framework, and you can decide with clarity and confidence like top investors, leveling the playing field and putting control of your financial future back in your hands. Section 2. The Bedrock Principle. Long-term thinking. The single most important pillar of the smart money mindset is an unwavering commitment to long-term thinking. This stands in stark contrast to the short-term focus that dominates financial media and public discourse. Dumb money is obsessed with what will happen today, this week, or this month. It's constantly reacting to daily news headlines, quarterly earnings reports, and the volatile swings of the market. This frantic short-term perspective turns investing into a high-stress guessing game. Smart money, on the other hand, plays a completely different game. It concerns itself not with the next few months, but with the next few decades. Smart investors know true wealth isn't created overnight. It is cultivated slowly, patiently, and deliberately through the power of compounding. They view investments as ownership stakes in real businesses, not as lottery tickets for tomorrow. This long-term horizon lets them look past temporary noise and turbulence, focusing on fundamental value and growth potential. This orientation lets investors harness compound growth, which Einstein reportedly called the eighth wonder of the world. By reinvesting dividends and allowing assets to appreciate over many years, they create a snowball effect. As Anthony O'Neill suggests, even small, consistent investments can grow into millions over a 30-year period. A short-term trader misses out entirely by jumping in and out of positions, resetting the compounding clock, and incurring transaction costs and taxes. Adopting a long-term perspective is a conscious choice. It requires tuning out the daily chatter and resisting the urge to react to every market fluctuation. It means sticking with your strategy, even when it's out of favor or during temporary downturns. Understand that the stock market, over any given 10-year period, 20-year period, or 30-year period, has historically been a powerful engine for wealth creation. Smart money doesn't try to outsmart the market daily. It aligns with the market's long-term upward trend. This patience is not passive. It is a powerful strategic decision. Section 3. The art of managing risk, not avoiding it. Another critical distinction between smart and dumb money is how they approach risk. A common misconception among novice investors is they aim to avoid risk entirely. They hunt for guaranteed returns. They chase can't-lose investments, and often fall prey to schemes that are too good to be true. Or they become paralyzed by fear and avoid investing altogether, leaving cash in savings. That cash slowly loses purchasing power to inflation. Both approaches miss a basic truth. In investing, there is no reward without some level of calculated risk. Smart money doesn't try to eliminate risk. It manages risk intelligently. That's the key difference. They don't put all their eggs in one basket. They diversify across asset classes, stocks, bonds, real estate. As Ray Dalio warns, many buy great companies at terrible prices. That's risky. So smart money diversifies to limit any single failure's impact. This is called asset allocation. It's the strategic distribution of your investment capital. For example, consider the classic 60-40 portfolio. 60% to stocks for growth, and 40% to bonds for stability. Morgan Stanley notes this can deliver attractive risk-adjusted returns. This balance smooths the ride. When stocks drop, bonds can cushion losses and help investors stay the course without panic. Smart risk management also means strict limits on speculative bets. Take volatile assets like cryptocurrency. Allocate only a small, carefully considered slice. Morgan Stanley suggests 2 to 4% for growth portfolios. CNBC reports many choose a conservative 1 to 5% range. Small exposure lets you chase upside without risking your future. Risk isn't a monster to avoid. It's a force to be understood, respected, and managed. That's the point. Section 4. The unpopular discipline, resisting hype. In today's hyper-connected world, we are constantly bombarded with financial hype. Social media platforms, 24-hour news channels, and online forums are filled with chatter about the next big thing. A penny stock that's supposedly about to skyrocket, a new cryptocurrency that will go to the moon, or a technology trend that promises to change the world overnight. This constant stream of noise creates a powerful psychological pressure known as the fear of missing out, or FOMO. It preys on our desire for quick and easy wealth, urging us to jump on the bandwagon before it's too late. This is the siren song that leads the dumb money astray. Smart money, by its very nature, is deeply skeptical of hype. It understands that by the time an investment becomes a hot topic of conversation on TikTok or at a dinner party, the biggest gains have likely already been made. Early investors are often the ones selling their positions to the latecomers who are piling in based on emotion and social proof. Chasing hype is a reactive strategy. It means you are always one step behind. Smart investors aim to be proactive, identifying value and opportunity before it becomes popular. This discipline requires a strong internal compass and the ability to think independently. It means doing your own research. Smart money looks for durable competitive advantages, healthy balance sheets, strong cash flows, and sensible valuations. Even a great company can be a terrible investment if you pay too high a price. A lesson many learned during the dot-com bubble and again with the cooling of AI fever in 2025. Resisting hype is an unpopular and often lonely discipline. While everyone else is excitedly talking about their gains, you may be sticking to your boring strategy. It can feel like you're missing out on the party. But smart investors know that financial success is not about chasing fleeting moments of excitement. It's about executing a sound, logical process consistently over time. The party eventually ends, and those who arrived late are often the ones left to clean up the mess. Well, that's the reality. Section 5. The Contrarian's Edge. Buying fear, selling greed. One of the most quoted adages in investing, popularized by Warren Buffett, is to be fearful when others are greedy and greedy only when others are fearful. This simple phrase encapsulates a powerful strategy, yet it's very hard to execute. It requires acting as a contrarian, moving against the tides of market sentiment. Humans are social creatures, hardwired to seek safety in the herd. Going against the crowd feels unnatural. When markets are soaring and everyone is euphoric, that's the point of maximum financial risk. Greed takes over. Valuation and risk management get forgotten. People pile into assets at inflated prices. Smart money becomes cautious. They aren't necessarily selling everything, but they might be trimming their most overvalued positions, taking profits, and rebalancing their portfolios. They resist going all in at the top, seeing optimism as a warning sign. They choose prudence when others choose euphoria. Conversely, the point of maximum opportunity is when fear grips the market. Headlines scream crash. Investors dump holdings at any price, and it feels like the financial world is ending. This is when smart money gets interested. They see a sale, not a crisis. An opportunity to buy quality at a steep discount. While dumb money panic sells, smart money calmly executes its plan, buying great companies that have been unfairly punished in the sell-off. It's not rebellion. It's an understanding of market cycles and human psychology. Markets are cyclical, swinging between fear and greed, and these emotional extremes create mispricings in the market. Emotional detachment allows smart investors to exploit those dislocations. They buy pessimism and they sell optimism. It's incredibly difficult. It takes enormous emotional fortitude to buy when every instinct in your body is screaming to flee. But it is this discipline that is responsible for creating generational wealth. Yeah, that's the edge. If we were to boil down the difference between smart and dumb money to a single factor, it would be emotion control. You can have the most brilliant investment strategy in the world, a perfectly diversified portfolio, and access to the best research. But if you cannot manage your own emotions, you are destined to fail. The two most destructive emotions in investing are fear and greed. Greed leads you to take on excessive risk, chase speculative bubbles, and buy assets at absurdly high prices. Fear causes you to panic during market downturns, sell good investments at the worst possible time, and abandon your long-term plan. The financial markets are a real-time amplifier of these emotions. During a bull market, rising prices create a feedback loop of greed and FOMO, making you feel invincible and encouraging reckless behavior. During a bear market, falling prices create a spiral of fear and panic, making you feel like you need to sell everything immediately. Dumb money rides this emotional roller coaster, buying high in a state of euphoria and selling low in a state of despair. This is the classic formula for destroying wealth, and it repeats over and over. Smart money builds systems and processes to neutralize emotion in decision-making. They don't rely on willpower alone. Instead, they create a rules-based framework. This includes predetermined rules for asset allocation, when to buy, when to rebalance, and when to take profits. The plan is created during a moment of calm and clarity, to guide actions during the inevitable periods of chaos and stress. One of the most effective tools for emotional control is automation. Set up automatic monthly investments, a strategy known as dollar cost averaging, and you remove the decision-making from the moment. Investments happen automatically, regardless of market direction. That forces you to buy more shares when prices are low and fewer shares when prices are high. By turning investing into a systematic, almost boring habit, you remove the opportunity for fear and greed to sabotage your long-term goals. Mastering your emotions is the final and most important frontier of becoming a truly smart investor. Let's crystallize the differences we've discussed by painting a clear picture of two hypothetical investors: dumb money versus smart money. The dumb money investor is highly reactive. They start their day by anxiously checking their portfolio and scrolling through social media to see which stocks are trending and scrolling crypto feeds to see which coins are trending. They hear about a new tech company that is supposedly the next big thing from a post on Reddit, and driven by FOMO, they immediately buy a large position without doing any real research. Their portfolio is a chaotic collection of recent hype trades, with no underlying strategy or theme. This investor's journey is an emotional roller coaster. When the market is up, they feel like a genius and might even boast about their gains online. They might even be tempted to use leverage or take on more risk, convinced of their own brilliance. However, when the market inevitably turns, their world is turned upside down. As their hot stock pick starts to fall, initial confidence, then anxiety, fear, and outright panic. They watch the value of their portfolio plummet and, unable to withstand the pain any longer, they sell everything near the bottom, locking in their losses and vowing never to invest again, until the next bull market, when FOMO pulls them back in. Now, let's look at the smart money investor. Their approach is methodical and almost boring. They have a written financial plan with clear long-term goals. Their portfolio is built on a foundation of diversification, perhaps using a 60-40 stock-to-bond allocation, with a small, deliberate percentage allocated to higher-risk growth assets. They invest a set amount of money every single month, regardless of market conditions, using dollar-cost averaging. They focus on buying high-quality, dividend-paying companies or low-cost index funds, and they rarely check their portfolio more than once a quarter. They are not chasing trends, they are executing a plan. When the market falls, the smart money investor's emotional response is completely different. They don't panic. In fact, they view the downturn as an opportunity. Their automatic monthly investment now buys more shares at a lower price, which they know will accelerate their long-term growth. They might even choose to deploy some extra cash to buy more of their favorite high-quality assets while they are on sale. They understand that volatility is the price of admission for long-term returns. Because their strategy is built on principles and not on emotion, they can weather the storm with confidence, knowing that they are building a solid foundation for future wealth. Ultimately, the distinction between smart money and dumb money has nothing to do with your net worth, your education level, or your profession. You can be a billionaire and still be dumb money if you chase hype and make emotional decisions. Conversely, you can be a teacher, a plumber, or a nurse with just $50 a month to invest and be the smartest money in the room, simply by adhering to a sound, long-term strategy. The labels are not about your identity. They are descriptions of a thought process and a method of operation. This is the most empowering realization of all. Being a smart investor is a choice. It is the choice to prioritize education over entertainment. It's the choice to favor patience over speed. It's the choice to choose discipline over impulse. Build a plan and stick to it, even when it's difficult or unpopular. Accept that you cannot predict the future and build a portfolio that is robust enough to handle a wide range of outcomes. Focus on the things you can control: your savings rate, your asset allocation, your costs, and your own behavior. And ignore the things you cannot control, like the daily movements of the market. This means you can start being a smart investor today, right now, regardless of your starting point. You don't need permission from Wall Street. You don't need a secret password. Commit to a set of principles. Think long-term. Manage risk through diversification and proper allocation. Ignore the hype and the noise from social media. Learn to see market fear as an opportunity. And above all, build a system that protects you from your own worst emotional instincts. These are the rules of the game, available to everyone. As we move to strategies for 2025, let go of feeling on the outside looking in. Smart and dumb money are not fixed identities. They are mindsets you can choose at any moment. Choose discipline. Choose patience. Choose strategic thinking, and you stop playing by someone else's rules. You are taking control and positioning yourself for long-term financial success. It's not about who you are, it's about how you decide to invest. In the dynamic landscape of 2025, one of the most important distinctions is how smart money approaches the market versus how it's portrayed in popular culture. The prevailing image: fast-paced, high-stakes action. The day trader, glued to flashing charts, making dozens of buys and sells in one session to scalp tiny profits minute to minute. It's glamorized as the quickest path to wealth. The hard reality. For most people, day trading is the quickest path to financial ruin. Smart money avoids that game. Day trading is not investing, it's speculating on short-term noise. It asks you to predict emotional market whims consistently. Even sophisticated algorithms and pros struggle to do that. You're competing with high-frequency firms with billion-dollar infrastructure. They execute trades in microseconds. The game is heavily stacked against the individual investor. Constant trading also creates big transaction costs, and it triggers costly tax liabilities. Those costs eat into any profits, a constant headwind. In 2025, smart money rejects this approach. The focus has shifted away from timing short-term gyrations. Instead, time in the market. Real value is created over years and decades, not minutes and hours. Smart investors stop treating stocks as fleeting digital numbers. They view them as fractional ownership in real businesses. That shift turns the goal from quick profits to long-term value accumulation. It's a more reliable, less stressful path. First rule for smart strategies in 2025. Abandon the gambler's mentality. Accept you won't get rich tomorrow. Trade the adrenaline rush for quiet confidence in a long-term plan. The market is not a casino. Treating it like one is a surefire way to lose. Smart money focuses on proven, time-tested principles that build wealth methodically. The strategies that work are often less exciting, but lead to better long-term results. If the strategy is not day trading, then what is it? The core philosophy of a smart stock investor is simple yet profound. Buy and own pieces of high-quality companies. This isn't about buying a ticker symbol that you hope will go up. It's about becoming a part owner in a durable, profitable, and well-managed business. A quality company has a strong competitive advantage, a moat that protects it from competitors. This could be a powerful brand, a unique technology, a network effect, or significant economies of scale. That moat lets the company generate consistent profits and grow earnings over time. Identifying quality means looking beyond daily price moves and into the business fundamentals. Smart investors ask critical questions. Does the company have a history of consistent revenue and earnings growth? Does it have a healthy balance sheet and manageable debt? Is it generating strong and predictable cash flow? Is it run by a competent, trustworthy management team acting in shareholders' best interest? This process is more like being a business analyst than a market timer, a qualitative and quantitative assessment of long-term viability. Focus on quality provides a crucial margin of safety. A well-run, profitable company is far more likely to weather economic downturns, to navigate industry shifts, and emerge stronger. Speculative, unprofitable companies with no clear business model are often the first to fail in tough times. Anchoring your portfolio in quality means you're investing for growth and building a defensive foundation that helps protect your capital during market stress. This is a key element of the risk management we discussed earlier. Once you have identified and purchased shares in high-quality companies, the next step in the smart money strategy is often the most difficult: doing nothing. The discipline of holding on to your investments for the long term is a simple concept, but it is profoundly challenging in a world that encourages constant action. Yet some of the greatest fortunes in history have been built not through frenetic activity, but through the power of patient, long-term ownership. Holding for the long term allows the magic of compounding to work its wonders. By selling too early, you cut short compounding. You might lock in a small gain, but you forfeit much larger returns that accumulate over 5 years, 10 years, or 20 years. A long-term holding strategy is also much more efficient from a tax and cost perspective. Selling within a year often triggers higher short-term capital gains tax. That tax efficiency can add significantly to your lifetime returns. However, buy and hold is not buy and forget. Smart investors periodically review their holdings to confirm the original investment thesis remains intact. Is the company still a leader in its industry? Is its competitive advantage still strong? Has the management team changed for the worse? The default action is to continue holding unless something fundamental in the business has permanently deteriorated. This is what transforms you from a mere speculator into a true long-term investor. Section 4. Getting paid to wait. The magic of collecting dividends. A key component of the smart money strategy for 2025, especially in an environment where easy cash yields are fading, involves focusing on companies that not only grow, but also share their profits directly with their owners. This is done through dividends. A dividend is a cash payment that a company makes to its shareholders, typically on a quarterly basis. It is a tangible return on your investment, a reward for your ownership stake in the business. For smart investors, dividends are not just a nice bonus. They are a critical part of the total return equation and a powerful indicator of a company's financial health and stability. Companies that pay consistent and growing dividends are often mature, stable, and highly profitable. They generate more cash than they need to run and grow the business, and they choose to return that excess cash to their shareholders. This demonstrates financial discipline. Unlike reported earnings, which can sometimes be manipulated, a cash dividend payment is real. You cannot fake cash. Collecting dividends provides a steady stream of income. This income is paid out regardless of day-to-day stock market fluctuations. During a market downturn, when stock prices are falling, that dividend check still arrives, providing a psychological cushion and a financial cushion. This cash flow can be used to pay bills, reducing your reliance on selling assets to cover living expenses, or it can be reinvested to buy more shares, further accelerating the compounding process. As noted by sources like 24/7 Wall St, the benefit of a dividend has become clearer as a hedge against inflation and a source of compounding income. Focusing on dividend-paying stocks transforms your portfolio from a place of pure speculation on growth into a productive asset that generates real cash flow. This is a cornerstone of building passive income. We'll discuss more later. It shifts the focus from solely relying on capital appreciation to a more balanced approach combining potential growth with a reliable income stream. This dual source of return makes a portfolio more resilient and provides a smoother, less stressful investment journey. Smart money loves getting paid to wait for their quality companies to grow. Section 5, the automatic wealth builder. Using dollar cost averaging, one of the most powerful and practical techniques used by smart investors to implement their strategy is dollar cost averaging, or DCA. This is the simple practice of investing a fixed amount of money at regular intervals, such as monthly or bi-weekly, regardless of what the market is doing. The mathematical genius of dollar cost averaging lies in how it influences your average purchase price. When the market is up and prices are high, your fixed dollar amount buys you fewer shares. When the market is down and prices are low, that same fixed dollar amount buys you more shares. Over time, this discipline forces you to buy more shares at lower prices and fewer shares at higher prices. This can result in a lower average cost per share than if you had tried to time the market. It automatically enforces the contrarian principle of buying more when things are cheaper. The psychological benefits of DCA are perhaps even more valuable. It removes the stress and anxiety of trying to decide the perfect time to invest. The fear of investing a large sum of money right before a market crash paralyzes many potential investors, causing them to stay on the sidelines for years, missing out on significant gains. Dollar cost averaging solves this problem. The decision is already made. The investment happens automatically, taking emotion completely out of the equation. This strategy makes investing accessible to everyone, regardless of their starting capital. As financial advisor Anthony O'Neill suggests, you don't need huge amounts of money to begin. A consistent monthly investment of even $50 or $100 can grow into a substantial sum over decades, thanks to the combined power of DCA and compound growth. It aligns perfectly with how most people earn and budget their money, on a monthly basis. By setting up automatic transfers from your paycheck to your investment account, you are paying yourself first and ensuring that you are consistently building your long-term wealth without having to think about it, Section 6, Sector Spotlight 1, the enduring power of large-cap tech. When smart money constructs a portfolio for 2025, it doesn't just buy companies at random. It strategically allocates capital to sectors with strong, long-term secular growth trends. One of the most dominant and enduring of these is large-cap technology. These are the giant, established companies that form the backbone of our modern digital economy. Think of the companies that provide the cloud computing infrastructure that powers the internet, the software that runs our businesses, the digital advertising platforms that connect sellers with buyers, and the consumer electronics that are integrated into our daily lives. The reason smart money continues to favor these giants is their immense scale and deep competitive moats. These companies possess fortress-like balance sheets with mountains of cash, allowing them to invest heavily in research and development, acquire innovative smaller companies, and weather economic storms with ease. Their products and services are often deeply embedded, creating incredibly sticky, recurring revenue streams. They are no longer just tech companies. They are essential utilities for the 21st century economy. They are the definition of quality companies. Even as the initial AI hype may have cooled, as noted by US News in 2025, these large-cap tech firms are the primary beneficiaries and enablers of the ongoing technological revolution. They own the data centers, design the advanced chips, and build the software platforms upon which new innovations like artificial intelligence are built. Their role is foundational. Investing in them is not a speculative bet on a single new technology, but a broader investment in the continued digitization of our world. For a balanced portfolio, these companies often serve as a core holding. They offer a compelling combination of potential long-term growth and a track record of profitability and resilience. They are the modern-day blue chips, providing the engine for capital appreciation over the long term. While large-cap tech provides the foundation, smart money is also looking toward the next layers of innovation that are being built on top of it. The field of artificial intelligence and automation represents one of the most transformative technological shifts of our lifetime. Although the initial speculative fever may have subsided, the real long-term implementation of these technologies is just beginning. In 2025, the focus is shifting from hype to practical AI in the real economy. Smart investors look beyond obvious names and explore the entire AI ecosystem. Companies developing core AI models and those providing the essential picks and shovels. Semiconductor companies, software companies, robotics firms. A diversified approach captures broad growth without betting on one unproven tech. The investment thesis: AI and automation are a deflationary force that boosts productivity. Adopters can lower costs, improve products, and gain significant competitive advantage. That leads to higher profit margins and faster growth. This is a decades-long theme, not a months-long trade. Smart money avoids short-term AI news noise. They patiently accumulate positions in key enablers and intelligent adopters. Like the internet revolution, AI's impact will unfold over a long period. Strategic allocation positions investors to benefit from one of the next generation's biggest drivers of growth and disruption. Another cornerstone sector for a smart, long-term portfolio is healthcare and biotechnology. This sector benefits from powerful, non-cyclical demographic tailwinds. As the global population ages, particularly in developed countries, demand for healthcare services, medical treatments, and innovative therapies is structurally set to rise. Unlike consumer discretionary spending, spending on health is non-negotiable. That gives the sector a defensive quality. Smart money sees opportunity across a wide healthcare spectrum. Large established pharmaceutical companies, medical device manufacturers, health insurance companies, and hospital operators. This diversity lets investors build balanced exposure. The biotechnology subsector is where the higher growth, higher risk opportunities lie. These are the companies on the frontiers of science, developing novel treatments for some of humanity's most challenging diseases, like cancer, Alzheimer's, and rare genetic disorders. Investing in individual clinical stage biotech stocks can be highly speculative, as their success often hinges on binary clinical trial outcomes. To manage this risk, smart investors often gain exposure through diversified ETFs or by focusing on larger biotechs with multiple drugs in their pipeline. This allows them to tap into the potential of medical breakthroughs while mitigating the risk of any single trial failure. Investing in healthcare and biotech is a bet on human ingenuity and our collective desire to live longer, healthier lives. It aligns financial goals with long-term societal progress. While technology and healthcare represent the future of innovation, smart money also recognizes the critical importance of the physical world. The energy and infrastructure sectors form the backbone of the global economy, providing the power that lights our homes, the materials that build our cities, and the transportation networks that move goods and people. In 2025, this sector is particularly interesting as it stands at the intersection of traditional needs and a massive, multi-decade transition toward a more sustainable future. On one hand, traditional energy companies continue to play a vital role. Many of these established firms are generating enormous cash flows, which they are returning to shareholders in the form of substantial dividends and share buybacks. On the other hand, there is the massive growth opportunity in renewable energy and the infrastructure needed to support the green transition, such as electric grid upgrades, battery storage facilities, and new renewable power generation projects. Infrastructure more broadly is an attractive asset class for long-term, risk-averse investors. This includes assets like toll roads, airports, pipelines, and data centers. These businesses often operate like monopolies and have very stable, predictable, and often inflation-linked cash flows. This sector provides a grounding in the real economy, offering a tangible source of value and income that complements the more growth-oriented technology and healthcare components of a well-diversified portfolio. It is an investment in the foundational assets that make modern life possible. Section 12. The boring path to profit. Why consistency outperforms excitement. As we conclude this deep dive into stock market strategy for 2025, a clear theme emerges. The smart money approach is decidedly boring. It lacks the thrill of day trading. It lacks the excitement of chasing meme stocks. It lacks the drama of trying to time market tops and bottoms. It is a methodical, disciplined, and patient process. It involves buying quality companies. It involves holding them for the long term. It involves collecting and reinvesting dividends. It involves systematically adding new capital through dollar-cost averaging. There are no secret formulas, no get-rich-quick shortcuts, and no guarantees of overnight success. This boring strategy is profitable precisely because it is boring. It is built on timeless principles that have proven to work through bull markets and bear markets. It works through periods of high inflation and low inflation. It endures through technological and economic shifts. It focuses on business profitability and compound growth. Because it is a calm, rules-based approach, it protects you from those wealth-destroying emotional mistakes. It replaces fear and replaces greed with discipline and with consistency. The truth is, successful investing should not be a source of excitement in your life. It should be a stable, reliable background process that works quietly to build your wealth over time, allowing you to focus on what truly matters: your family, your career, your health, your happiness. The goal is to reach your financial objectives with the highest degree of probability and the lowest amount of stress. Therefore, embrace the boring. Celebrate the consistency. As Morgan Stanley suggests, simple frameworks like a balanced allocation can be the ideal solution. The path to building lasting wealth is not a sprint. It is a marathon paved with disciplined habits. By adopting this patient and methodical strategy, you align yourself with time-tested smart money principles and the most reliable path to long-term financial success. Now, let's turn our attention to one of the most exciting, controversial, and misunderstood asset classes of our time: cryptocurrency. The stories surrounding crypto are often extreme. On one hand, you hear tales of overnight millionaires. On the other hand, you hear horror stories of devastating losses, scams, and market crashes that wipe out life savings in an instant. This polarizing narrative makes it difficult for a rational investor to know how to approach this new and volatile space. It's a world filled with hype, hope, and a tremendous amount of noise. Here is the simple, unglamorous truth that most crypto enthusiasts and social media influencers don't want you to hear. Smart money does not, under any circumstances, go all in on crypto. They do not bet the farm on Bitcoin, Ethereum, or any other digital asset. They do not liquidate their stock portfolio or take out a second mortgage on their house to buy the latest trending coin. This all-or-nothing approach is not investing. It is reckless gambling. It is a lottery ticket mentality, completely at odds with prudent wealth management and risk control. The smart money approach to cryptocurrency is defined by caution, skepticism, and a deep respect for risk. They see the potential, but they are also acutely aware of the immense volatility, regulatory uncertainty, and technological risks. They understand that this is a nascent asset class. Therefore, they approach it not as a cornerstone of their financial future, but as a small, speculative position within a much larger, well-diversified, and fundamentally sound investment strategy. It is an experiment, not a core belief system. This might sound overly conservative or even boring, especially compared to the wild promises of 100 times gains plastered all over the internet. But this conservative approach is what protects smart investors from catastrophic losses. It allows them to participate in the potential upside of this emerging technology without exposing their entire financial well-being to its downside. It is the difference between making a calculated bet and making a foolish gamble. Before you even consider investing a single dollar into crypto, you must internalize this fundamental truth. Moderation and risk management are not optional. They are the absolute price of admission. So, if smart money isn't going all in, how exactly do they view crypto? They treat it as a specific tool for a specific job within their overall portfolio. The job of cryptocurrency in a smart money portfolio is to act as a satellite position, high growth and high risk. It is an asset that has the potential for asymmetric returns. This perspective is crucial because it separates the investment from the ideology. In the crypto world, it is very easy to get swept up in the quasi-religious fervor that surrounds certain projects. People become true believers. This emotional attachment is the enemy of good investing. Smart money remains agnostic. They see crypto not as a movement or a belief system, but as an asset class. It is a tool in their financial toolkit. By viewing crypto as a tool, you can make more rational and objective decisions. This means not getting emotionally attached to any single coin or project. They don't marry their bags, a crypto slang term for holding on to a losing investment out of blind faith. A smart investor is willing to sell a cryptocurrency that has performed well to take profits, or to cut one that is failing to meet its objectives. The crypto landscape is evolving at an incredible pace. Smart money stays nimble. The single most important rule is to establish strict and non-negotiable allocation limits before you invest. As simulations from Morgan Stanley showed, adding just a 6% crypto position to a growth portfolio can nearly double overall volatility. So, what does a strict limit look like? For most investors, crypto should be a small, single-digit percent of investable assets. Example, a $100,000 portfolio. Consider allocating $1,000 to $5,000. This is an amount that, if it went to zero tomorrow, would be painful and disappointing, but it would not derail your long-term financial plan. Only invest what you can genuinely afford to lose. Set these limits in stone before market moves influence you. That's why a written investment plan matters. It acts as a contract with your future self. This discipline works both ways. It prevents overbuying in euphoria and provides a framework during crashes. Your rebalancing plan may call for buying a small amount to return to target. That enforces contrarian discipline. Let your preset allocation rules govern your actions, not the emotional whims of fear and greed. This structured approach is what separates a smart crypto investor from a gambler. Section 5. Beyond the hype, focusing on infrastructure and utility. Once you have determined your allocation, where to invest it? The dumb money chases hype. They buy coins based on cute dog mascots, celebrity endorsements, or promises of impossible returns. They are drawn to projects with a lot of marketing, but very little substance. These meme coins often experience spectacular pumps followed by even more spectacular dumps. They are cultural phenomena, not serious long-term investments. Smart money takes the opposite approach. They ignore the hype and focus on utility and infrastructure. They look for projects that are building the foundational layers. This is the crypto equivalent of investing in the companies that built the railroads, power grids, and fiber optic cables of previous technological revolutions. These are the picks and shovels of the crypto world. What does this infrastructure look like? It primarily includes the major Layer 1 blockchains, like Bitcoin and Ethereum. Bitcoin is increasingly seen as a form of digital gold. Ethereum is a decentralized computing platform. Investing in these foundational platforms is a bet on the growth of the entire ecosystem that is being built on top of them. Beyond the major Layer 1s, smart investors may also look at other key infrastructure categories. This could include Layer 2 scaling solutions, decentralized finance, DeFi, protocols, or blockchain oracle networks. In traditional finance, the custody of your assets is something you rarely have to think about. In the world of cryptocurrency, however, the paradigm is different. Not your keys, not your coins. This means if you leave your crypto on a centralized exchange, you are trusting that exchange to keep your assets safe. Centralized exchanges are major targets for hackers. Exchanges can go bankrupt or be shut down by regulators. The solution: take self-custody using cold storage. Move your crypto off exchanges onto a hardware wallet. A hardware wallet is a small physical device that stores your private keys offline. It's like putting gold bars in a secure personal vault instead of leaving them on someone else's desk. In the fast-paced world of crypto trading, one of the most tempting and dangerous tools offered by many exchanges is leverage. This sounds incredibly appealing. However, leverage is a double-edged sword that magnifies losses just as powerfully. Smart money avoids leverage like the plague. If you take a 10 times leverage position and the asset price moves against you by just 10%, your entire initial capital is wiped out. The simple truth is that you do not need leverage to achieve spectacular returns in crypto. The underlying assets themselves are volatile enough. The potential for growth is already there. Adding leverage is like pouring gasoline on a fire. Smart money focuses on managing risk, not amplifying it. They build wealth through patient capital accumulation, not through high-stakes, leveraged bets. To reinforce these principles, it is helpful to look at how the smartest money of all, pension funds, endowments, and corporate treasuries, are approaching the crypto space in 2025. For years, these conservative, risk-averse institutions stayed on the sidelines. With growing regulatory clarity, they are now beginning to enter, and their approach is a masterclass in prudent risk management. Their participation is not a signal to be reckless. It is a model for how to be disciplined. First and foremost, institutions are making very small, carefully considered allocations. A recent Coinbase survey revealed that while many professional investors plan to increase their crypto holdings, they are often starting from a base of zero and targeting allocations that remain a tiny fraction of their total assets under management, AUM. They are dipping their toes in the water, not diving in head first. Second, institutions are heavily focused on regulatory compliance and security. They are not buying obscure coins on unregulated offshore exchanges. They are primarily gaining exposure through regulated products like the spot Bitcoin ETFs. These products allow them to invest in Bitcoin through a familiar, regulated investment vehicle, managed by trusted financial giants like BlackRock and Fidelity. Finally, their investment thesis is long-term and often focused on Bitcoin's potential role as a new store of value or a portfolio diversifier. Beyond the potential for high growth, the most intellectually honest reason to include crypto in a portfolio is for its potential diversification benefits. Diversification is the art of combining assets that have a low correlation. Crypto's price is often driven by different factors, like network adoption, halving cycles, and regulatory news, than traditional assets, which are driven by corporate earnings, interest rates, and economic growth. But it's important to be skeptical. While crypto has shown low correlation at times, it has also shown high correlation during periods of market stress. In a panic, investors tend to sell all their risky assets at once. As David Seymour of Wave Digital Assets noted to CNBC, because crypto provides rocket fuel, you should position the rest of your portfolio more conservatively, with more value stocks or bonds, for example, to manage that volatility. Smart money is nuanced. Crypto is viewed as an imperfect diversifier that may improve risk-adjusted returns over the long term, but it is not a magic bullet. That's why allocations are kept small. Because of its extreme volatility, a crypto position can quickly grow or shrink. This is where the discipline of rebalancing becomes absolutely critical. It is a systematic way to take profits and manage risk. So, let's bring it all together. The Smart Money Playbook provides a clear and proven roadmap for doing so responsibly. By following these rules, you can navigate the exciting and treacherous world of cryptocurrency with the confidence of a disciplined investor, not the anxiety of a hopeful gambler. Section 1. The Smart Money Obsession: Why Income is King. Beyond the pursuit of capital appreciation through stocks and crypto, smart money has a deep and abiding obsession with income. While growth is exciting and grabs the headlines, income is the steady, reliable workhorse that builds true financial resilience and freedom. So, why this obsession with income? First and foremost, a reliable income stream dramatically reduces financial stress. When you have money coming in from your assets every month or every quarter, you are less dependent on your primary job. This creates a psychological and financial buffer that can be life-changing. There is a baseline of income that will continue to flow in. Second, income is the fuel for reinvestment and accelerated growth. When your assets generate cash, you can use that cash to buy more assets. Your portfolio begins to feed itself. Ultimately, the goal of generating passive income is to create freedom. It's the freedom to choose how you spend your time, whether that means retiring early, pursuing a passion project, working less, or dedicating more time to your family. For smart money, this is the end game. It's not just about accumulating a large net worth on paper. It's about building a system that provides the cash flow to live life on your own terms. Section 2. The Foundation: Dividend Stocks as an Income Engine. The foundational strategy for building a passive income portfolio is investing in high-quality dividend-paying stocks. It turns ownership from a bet on price into a tangible, income-producing asset, much like owning a rental property that pays rent every month. Dividend stocks are especially appealing in 2025. As noted by publications like 24/7 Wall St, after a period of high rates, those yields are now starting to decline. That makes consistent, potentially growing dividend income more attractive. Unlike fixed interest from a bond or a savings account, dividends from healthy companies can grow over time. As a company increases profits, it can raise its dividend payout, giving you a raise in passive income year after year. That dividend growth helps protect your purchasing power against the corrosive effects of inflation. If your dividends are growing at or above the rate of inflation, you can maintain or even improve your standard of living over the long term. For many investors, a simpler, more diversified, and lower-stress approach is to use dividend ETFs. A dividend ETF is a single fund you can buy like a stock, but it holds a basket of dozens or even hundreds of dividend-paying companies. This provides instant diversification. As highlighted by sources like Morningstar, these funds provide instant diversification by holding a basket of dozens or even hundreds of dividend-paying stocks. Dividend ETFs are, in general, low-cost and easy to buy and sell. However, not all dividend ETFs are created equal. They follow very different strategies. It's important to understand an ETF's strategy and ensure it aligns with your goals. As one expert said on CNBC, finding companies that can pay safe and rising dividends is about as close as it gets to true passive income. It's the cornerstone of a resilient, cash flow-focused investment strategy. Section 4. Beyond Stocks: The Role of Interest-Earning Accounts in 2025. While dividend stocks and ETFs form the growth engine of an income portfolio, smart money also understands the importance of stability and liquidity. This is where interest-earning accounts play a crucial, albeit different, role. The primary vehicle for this is a high-yield savings account, or HISA. Unlike a traditional savings account, online banks and financial technology companies often offer HISAs with significantly more competitive rates. This is the ideal place to park your emergency fund, and HISA allows your safety net to work for you, earning a modest but meaningful return. Section 5. The Digital Landlord, generating income from digital assets. Moving into more modern and entrepreneurial territory, smart investors in 2025 are also exploring ways to generate passive income from digital assets. This is the digital equivalent of being a landlord. One of the most established models is creating and monetizing content. This could be a YouTube channel, a blog, a podcast, or a newsletter. Monetization can come from advertising revenue, affiliate marketing, or selling your own digital products like ebooks and online courses. Section 6. The Entrepreneurial Stream, building online businesses for cash flow. A classic example is an e-commerce business using a model like dropshipping. You create an online storefront to sell products, but you don't hold any inventory yourself. Your profit is the difference between your selling price and the wholesaler's price. Another model is software as a service, or SaaS. This involves building a software product that solves a specific problem and charging recurring monthly or annual subscription fees for its use. It's essential to circle back to the ultimate purpose behind building these passive income streams. The goal is not simply to accumulate money. The goal is to use that money to buy back your time and to create a life with more freedom and optionality. This freedom shows up in many ways. The freedom to leave a job you dislike. The optionality to switch to a lower-paying but more fulfilling career. The ability to take a sabbatical to travel the world. This is why smart money focuses on income, because true wealth isn't measured by the size of your portfolio, but by the degree of control you have over your time and your choices. The ultimate return isn't a number on a statement. It's a life with more autonomy, purpose, and peace of mind. Let's talk about what not to do. Biggest mistakes. Going all in on one asset. Using leverage. Following TikTok hype. Panic selling. Not having a plan. One of the most common and catastrophic mistakes a beginner investor makes is falling for the all-or-nothing fallacy. You take all your savings and go all in, betting the farm on a single outcome. This approach is incredibly dangerous because it completely ignores the most fundamental principle of sound investing: diversification. Smart money never puts all its eggs in one basket. Even the most promising company can fail. A competitor could emerge. A new regulation could cripple the business model. A clinical trial could fail. A key executive could leave. Another siren song that lures beginner investors toward financial ruin is the promise of leverage. With leverage, this same move can trigger a margin call or an automatic liquidation, wiping out your entire initial investment in a matter of minutes. Using leverage also has a profoundly negative psychological impact. It transforms the relatively calm process of long-term investing into a high-stress, white-knuckle gambling session. The simple, non-negotiable rule for beginners is to avoid leverage entirely. In the digital age, a new and pervasive mistake is outsourcing your financial decisions to social media. They create a powerful echo chamber of hype. Many are running pump-and-dump schemes. They are not your friends. They are using you as their exit liquidity. Of all the mistakes a beginner can make, perhaps the most common and most damaging is panic selling. This action is the cardinal sin of investing because it turns a temporary, on-paper loss into a permanent, real-world loss. The antidote to panic is having a plan. Your plan, created during a moment of calm and rationality, serves as your anchor in a storm. Automate your investing process as much as possible. This ensures you are investing consistently and takes emotional, short-term decision-making completely out of the equation. Wealth is built slowly, not overnight. Embrace a long-term, boring mindset. Once your automated plan is in place, your primary job is to be patient and let it work. We have covered a tremendous amount of ground, from the core mindset of a smart investor to specific, actionable strategies for building wealth safely in 2025 and beyond. The journey to financial independence begins not with a perfectly optimized portfolio, but with a single, decisive action. It could be opening a brokerage account, making your first small contribution, or simply writing down your financial plan. Do not wait for the perfect time to start, because it will never come. The smart money investor knows that the best time to plant a tree was 20 years ago. The second best time is today. If you learned something from this video and are ready to start your journey, show your support by hitting the like button and subscribing to the channel. And to commit to your new mindset, comment "Smart Money" down below. This channel is about real wealth education, not hype. Join our community of disciplined, long-term investors. Your journey starts now.